Hello everyone, welcome to the first episode of the TCPA master classes. Today we ain't just learning a strategy, we are learning to read the code of the market. Most traders see candles, patterns and indicators. They see hope. In this channel we see physics, we see binary numbers. And today I'm going to introduce you to the gravity 12.0 mode. We are going to break down why we treat the market as on or off or like a switch, and how we use a 5-second time frame to exploit the internal rhythm of price action. Don't really worry about the things which I've drawn here. You'd get to understand them, and I've just used even a moving average just to give an example of what an on and off variable would look like. I've just used the EMA because a lot of people are more familiar with this kind of indicators, and a lot of them they have used them, so when I speak someone can actually get to relate to that which I'm saying. And on the right, that's the truth table. You'll get to understand it as time goes on. For now, you shouldn't really worry yourself if you can't understand the things that I've written down concerning those tables. So let's start with the foundation. What is a binary number in trading? Think of a simple moving average like I've just shown here. When a small MA crosses a big MA to the upside, your setup says buy, right? Now, if the very next buy is bullish, moving meaning the market did exactly what the setup predicted, we call that a normal variable. In our model, we label that as a 0 BI. Like in the illustration, I used a bearish moving average. I mean, this is a small moving average indicated by a cut line, and this line indicates a bigger moving average, and in this case I used a bearish example. You can see this moving average, it crossed through the bigger moving average, and that indicates a sell. And like I said, if now you get price, if you see this cut line, I think it's exactly on the crossover of the EMAs. Now if we get the output bar following through the direction of our prediction, and in this case a sell signal would indicate that we sell. Now the following bar, it took the direction of our prediction, and in that way we know that we have a normal variable. Now if that same crossover happens but the next bar fails and turns bullish, then the setup has failed and its initial expectation. We call this an inverse variable. We label that as 1 BI, just like I've written down here. But here, when this output bar now becomes bullish on a crossover which indicates a sell, now that scenario, or we label that scenario or that setup, we label it as inverse. Why do we do this? Because as binary option traders, you are a data processor. By converting complex price action into zeros and ones, we remove the emotion of winning or losing and replace it with the precision of verifying the code. That's what we are doing. So that's why we need to do all these things. So if you can actually, if you are following through right now, you'd realize that even our system is not based on something like a rigid setup. A setup can do either a buy or a sell. The very same setup. It depends on the flow of the market. If you are flowing on the 0 BI mode or if you are flowing on the 1 BI mode. Our TCPA system is built on 8 rigid setups. We don't guess, we analyze 3 layers of data to get our binary output. Now, one, we use pressure, and we get that from the left hand of the analysis. And we'll talk more of this analysis, the left hand analysis, the right hand analysis, and all that which we do on those analyses. Now, like I said, first we have pressure analysis, and we do that on the left hand side. There we check if the pivot bar or price action on the left hand was the trend strong or weak, basically, and we'll have two variables there. From there, then we want to check the nature of the peak, and we do that analysis from the right hand analysis. And there we check if the peak is positive or if the peak is negative, and we indicate that through things like negative is for negative TR, positive is for positive TR. And after that, then we're gonna deal with the or analyze the context of the peak, because this left hand, right hand, they both happen on one peak. As you can see, the left hand analysis, the right hand analysis, both on one peak. And now when we are talking about the context now it's trying to actually see the overview of the setup and to classify it as either vertical or consolidation trend or a breakout peak. I'm sorry, these are peaks. It's either a vertical peak, a consolidation peak, or a breakout peak. Or sometimes you can have a pre-consolidation peak whereby price is just about to consolidate or it showed signs of a consolidation. So in this, when we are analyzing the context, then we'll have four variables. So for the nature of trend, since we on the right hand we are checking if we have a positive trend or a negative trend, there you can see we have two variables. And for pressure, still strong or weak, we have two variables only. That's why this table have 1 2 3 4, 1 2 3 4. Now if you can see, the variables are two only. On the left hand side we have either strong or weak, and on the right hand side we have positive or negative. So there are two variables on the right hand side. And in terms of the context now of the peak, because you know that one, it analyzes all the peaks and they go through the same loop. And there we will have four variables, because we can either have the market getting in a post consolidation, a complete consolidation, or a pre consolidation area whereby it's about to consolidate, or whereby now the market the peak have just appeared where there were just trends, no consolidation area. And the consolidation area, we do recognize it by alternating directions, like up down 4 times. That's a confirmation for a post consolidation area. And a pre consolidation area, that's the alternating move, same alternating move but 3 times. And for vertical peaks, there it's just the trend. Sometimes on the left hand we can have 2 bars, 3 bars, 4 bars, even up to 14 bars. Trends can go up to 14 bars before they reverse or terminate. So that's it about the context. And now, as if you can see on this table, we have like we have data 1, data 2. Now data 3, it's about if that same setup continued or failed. If I can use this example, in this example, this crossover, we can see price continued and the trend. And if this bar would be bullish, then we know that the trend have failed. So the setup can either be normal or invest, like I said. And that's why on the final binary output now we will have either a 0 meaning normal, that the setup was normal, or invest. And if you can see these lines, I've broken down this into 1, 2, 3, 4 sections. And if you can look at these sections, uh, it's like they are in that format simply because they work together. So when we combine this, we get 8 distinct scenarios. This is why we need binary numbers. If I told you to remember all 8 setups while trading a 5-second chart, you'd freeze. But if the system tells you setup number 4 is active, expect 0 mode, your job becomes simple. You are looking for normal output of the setup. So in other words, then you'd know if you have to place, you'd know how the normal setups look like. I think you have to move very quickly before the time elapses. Now let's talk about the ghost trend, a discovery that changed everything for our system basically. And this system is not just for the 5-second chart. We can do it on the 5-minute, even on an hourly or a daily chart. Doesn't really matter. So in pocket option, I often use a 10 seconds expiration on a 5-second chart for margin of safety, but this creates a time drift error. Look at this. Bar 1 moves in our predicted direction and wins for the analysis, but bar 2 reverses and takes our money, loss for the execution. But bar 1, once it moves in our predicted direction. That's our output bar, and that's where we actually take results from. And that win, it would indicate a win for the analysis. Now once the second bar, which we try to use for margin of safety, now that can also work against us, whereby price reverses and takes us out. And that kind of loss, we know that it's a loss caused by an execution error. So there is a certain way in which we can deal with such kind of things, uh, and that certain way, it's very simple. In the TCPA code, we fixed this. Instead of using the 10 seconds, we strictly set the expiration time equal to the traded time frame. We don't, if you're using 5 seconds, then we are trading that with the expiration of 5 seconds. Also 10 seconds, same thing. We don't want that kind of case scenario whereby we are trading a 5-second chart, then we increase the expiration time. It creates a time drift error. For some case scenarios where the first bar actually fails our prediction, we take advantage by repeating the same prediction immediately to recover on the next bar. And this is what we call a ghost trend or ghost trading. You do open 2 contracts to minimize the execution risk on the first contract, as we never know if it will become a win or not. It's good when we close and lock profits on the first bar than to wait for another, than to wait up until another bar takes us out. So if I can get to this example very quickly, I have like 1 minute remaining before the end of this video. And okay, so let's look at a case scenario whereby we have the expiration time of 10 seconds on a 5-second chart. So we can have a case scenario whereby the first bar, now it moves in our prediction. We make a buy contract, right? And then it moves in our direction. That's a win for our model. But immediately, if you look at the following bar after this bar, now it reversed immediately. And if we would be using the 10 seconds expiration time, this would take us out. Our contract would be taken out. And if, for that example of a ghost trading strategy, let's say we are using a fixed time, fixed to the time frame now, or set equal to the time frame, the expiration set equal to the time frame. Now we can have maybe a sell option instead of a buy option, and then price goes against our prediction for the first minute or for that 5 seconds. So normally I got to realize that sometimes the system fails from the initial moments, but on the next bar, it moves to our predicted direction. So instead of using 10 seconds to combine all this together now, we want to use two contracts instead of one contract. We open the first contract, yes, it loses, but we take another contract after the close of the output bar to try and make some recoveries. And this it doesn't mean that you'll always win. Sometimes you'd get that bad luck and you'd lose, but still, if you have proper risk management, you can still be able to make this. So in this case, since I don't have time, let's say we'll meet on the next videos, where on the next video or on the next lesson, where now I explain how to read a pressure mechanically. And I hope you'll be there. That's where the hardcore or the real stuff begins. That's where the real lessons will commence. So please join us on our next lessons, and please subscribe and share these videos. These videos I made them for the world, and you'd excuse me for making them on the piece of papers like this. um in the future you'll get some better videos, but obviously you'll have to pay for them. These ones are free because i I don't actually spend anything on them.